stop scrolling. Because what happened in the metals market over the last 24 hours is the kind of thing that either wakes you up or wipes you out. 1 minute, silver looks unstoppable. The next minute, it feels like someone pulled the floor out from under the entire trade. And here's the part nobody wants to say out loud. The wild price swings are not the story. The reason for the swings is the story. And that reason points straight at the people who hate it when regular investors hold real money. Comment what time you're watching right now, because I want to see where this audience is tuning in from. Quick heads up. The analytics show a huge chunk of you watch all the way through but still haven't subscribed. If these breakdowns help you think clearly, hit subscribe so you don't miss the next move. I'm John A.G., and today we're hitting 4 things, fast. First, the volatility ratchet that just tightened around gold and silver, and why yesterday's whiplash might actually be a warning shot for what comes next. Second, the quiet phone calls that allegedly went out from a major Wall Street bank telling clients to dump silver and rotate into gold, and why that sounds helpful on the surface but suspicious underneath. Third, the confiscation fear that shows up every time metals get hot, what history really says, and what the modern version would actually look like. Fourth, the big Zurich-style forecasts and the inflation math going viral, and how to think about them without getting tricked. Before we jump in, check the description. I put bonus links there, including a premium WhatsApp channel link and a channel membership join link. And if you want deeper dives, we also have members-only videos produced by a separate team, more research, more context, and built specifically for premium members. Short version, the public videos are the headlines, the members' videos are the full file. Now, volatility. Let's start where the adrenaline actually hit. Silver had just done something psychologically massive. It pushed into that triple-digit zone that makes people either euphoric or terrified. That level isn't just a price, it's a billboard. It tells the whole world something is straining. And once that billboard lights up, everybody shows up at the same intersection. Traders, hedgers, miners, market makers, and the people who just heard about silver yesterday. That's when the market does what it always does at emotional levels. It tests you. It dares you to blink. The move didn't look like a calm trend. It looked like a staircase with missing steps. Burst higher, pause, burst higher, pause. That kind of action is a tell. Usually means there's a fight happening behind the scenes between people who want higher prices and people who cannot afford higher prices. And when you see that fight, you have to stop thinking like a spectator and start thinking like a mechanic. What are the parts moving? Part 1 is leverage. A lot of money in modern markets is not cash buying. It's leveraged positioning. Futures, options, swaps, margin. Leverage is rocket fuel on the way up and a trapdoor on the way down. When price spikes, brokers raise margin. When margin rises, some traders don't have a choice. They sell whatever they can, whenever they can, to meet the call. That's why you can see selling in gold, even if the story was silver went crazy. It's not a philosophical sell, it's a forced sell. Part 2 is options hedging. Even if you never touch options, options touch you. When a lot of call options are purchased, the dealers who sold those calls often hedge by buying the underlying. As price rises, they buy more to stay neutral. That can push price higher faster than fundamentals alone would, but it works both ways. When price snaps down, that hedging can unwind and turn into mechanical selling. That's how you get those sudden air pockets where the chart looks like it fell through a trapdoor. Part 3 is the stop hunt. Big round numbers attract stops like magnets. People place protective orders just below obvious levels because it feels safe. The market knows that. And when liquidity is thin, the fastest way to find sell orders is to push price into the stop zone, scoop up the forced selling, and then let price rebound. It's brutal, but it's common. So if yesterday felt engineered, here's the better framing. Markets are designed to move toward liquidity. Stops are liquidity. Margin calls are liquidity. Panic is liquidity. And the market will happily harvest liquidity from anyone who sets up in predictable places. Volatility doesn't just rise randomly. It rises when uncertainty rises, when positioning gets lopsided, and when the story gets too popular. The second metals become dinner table conversation. Volatility shows up like an uninvited guest. From recent market updates, you can see the same pattern across risk assets when leverage gets crowded. Price races ahead, headlines explode, then a sharp reversal forces weak hands out, and only then does the trend reveal itself. Yesterday had all the fingerprints of that process. And here's the cliffhanger. That reversal might not be the end of the move. It might have been the admission ticket. Because after the drop, buyers showed up again. Not screaming buyers. Quiet buyers. The kind that don't tweet. The kind that buy when you're staring at red candles and asking yourself, am I the idiot? If you think metals are insurance, then the insurance premium is the emotional discomfort of holding them while everyone else is losing their mind. If you think metals are a trade, you need a plan that survives days like yesterday. Now, since we're talking about scarcity, let's separate 2 ideas that get mashed together. Paper metal can be created in huge size with a click. Physical metal can't. That difference matters the most when investors demand delivery, when industry needs supply, or when trust in paper promises weakens. Most of the time, the paper market sets the price and the physical market follows. But in certain windows, the physical tail can start to wag the paper dog. So when you see a violent intraday reversal, don't just ask, did the trend break? Ask, did someone just pay a premium to buy time? And buying time is what stressed participants do. They slam price down to create fear. They hope fear creates selling, and they pray that selling gives them supply. That's not ideology, that's survival. Now here's where it gets interesting. Right in the middle of that chaos, a story starts circulating that's way more important than a one-day candle. Allegedly, a major Wall Street bank has been contacting clients and nudging them to sell silver and move into gold. On paper, that sounds like normal wealth management. Reduce volatility, rebalance, be prudent. And if you only think at the surface level, you might even applaud it. But I don't live at the surface level. Not anymore. If silver is ripping higher and demand is hot, why would a big institution push clients away from it right now? There are two innocent explanations, and one not so innocent explanation. Innocent explanation number one, silver is more volatile. If you're managing older clients, conservative mandates, or portfolios that can't stomach big swings, you might recommend gold as the smoother ride. Innocent explanation number two, the gold to silver relationship swings. If your thesis is precious metals up, you can still express it with less whiplash through gold. Now the not so innocent explanation, what if the recommendation isn't about the client at all? Banks don't just give advice. Banks run books, they hedge exposures, they warehouse risk, they make markets. And when they're on the wrong side of a move, they don't call it panic. They call it guidance. According to the latest publicly available filings, large institutions disclose a lot, but not always the thing you actually want to know, which is where the real short risk sits, and how much of it is tied to physical constraints rather than paper promises. So here's the skeptical alternative perspective. The bank might be trying to cool silver demand because silver demand makes their life harder. If you got that kind of call, ask yourself this. Is this advice designed to protect my wealth or to protect someone else's balance sheet? And here's a question for the comments. If you had to choose only one for the next 12 months, gold or silver, what would you pick and why? Before we go deeper, I want to address something that's floating around in the background of all this. The refiners aren't buying scrap chatter. People hear that and instantly jump to the conclusion that demand must be fake or that the run is about to die. I don't buy that leap. A refinery's decision to slow scrap intake can be driven by 100 boring reasons. Capacity constraints, staffing, compliance paperwork, inventory management, even simple pricing spreads that make scrap less attractive for a week. Retail investors also tend to think their world is the whole world. It's not. The scrap stream is one channel, industrial supply chains are another, centralized wholesale flows are another, and when volatility spikes, every participant behaves differently for a period of time. So here's the takeaway. Don't let a single anecdote become your entire thesis. Instead, do what pros do. Separate the signal from the noise. Signal. Currencies keep losing purchasing power over time because the system is built to expand units. Noise, 1 week where a local shop changes its buying policy. And yes, that applies to more than the dollar. It applies to every fiat unit that can be created without restraint. If your wealth is stored purely as claims inside that system, you're betting your future on people you don't control making decisions you can't predict. That's not a moral statement. That's a risk statement. Here's how I keep my head straight when price swings feel violent. I ask one question. What am I actually holding? If you hold paper claims, you hold permission. If you hold physical assets, you hold possession. Those are not the same, and that's why volatility triggers identity crisis for some people. Because deep down they didn't buy metals as an asset. They bought metals as a protest against the system. Then the system gives them a roller coaster, and suddenly the protest gets uncomfortable. That's when people sell the thing they said they believed in. So let's get practical. If you're watching this and you feel your heart rate rising every time the chart moves, your position size might be too large. That's not an insult. That's information. A position that destroys your sleep is a position that controls you. Reduce it, restructure it, or change the time horizon. Now, let's make this even more concrete with a simple thought experiment. Imagine you wake up tomorrow and silver is down sharply again. The internet screams, bubble. The same talking heads who mocked metals last year are suddenly concerned for your safety. What do? If your answer is, I'd panic, then you don't have a plan. You have a hope. Now imagine the opposite. You wake up tomorrow and silver is up massively again and gold is ripping and you feel that intoxicating urge to brag, to go all in, to chase leverage because you want to turn a good move into a legendary move. What do? If your answer is, I'd add leverage, then you also don't have a plan. You have a dopamine addiction. The plan lives in the middle. The plan is define your purpose, define your time frame, and define your exit rules before the market forces you to decide under pressure. If you're successful, share your success story in the comments so others can stay motivated. Now, with that mindset set, we can talk about the bank calls without turning it into a soap opera. Because the calls matter less than the bigger message. Somebody wants you to treat silver as disposable right now. And when I hear that, I ask what I'm not supposed to ask. What happens if too many people refuse? That's the cliffhanger. Because if enough people hold, the market has to clear at a higher price. And when a market has to clear at a higher price, it reveals who is swimming without shorts. So let's zoom back out and connect the dots the way institutions do. There are 3 games happening at once. The price game, the narrative game, and the liquidity game. The price game is what you see. The narrative game is what you hear. The liquidity game is what decides who survives. And right now, the liquidity game is telling us something. The system is stressing, and stressed systems do weird things, which is why the gold to silver discussion matters more than most people realize. Let's talk about the gold to silver relationship, because this is where a lot of people get tricked by a simple ratio. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. That's the quick version. The problem is that the ratio can stay extreme for longer than your patience can tolerate. So using it as a timing tool can backfire. Here's the way I think about it. Gold is the monetary anchor. Silver is the hybrid. Money plus industry. In calm times, gold's monetary role can feel boring. In chaotic times, that boredom becomes a superpower. Silver, on the other hand, can behave like a caged animal. It sleeps, it sleeps, it sleeps, and then it explodes. That's why rotate out of silver right after a breakout feels backwards to me. It's like telling someone to step off the runway right as the plane finally starts accelerating. But I will concede a fair point. There is a version of this advice that's rational. If silver just made you a life-changing gain, and your position size has become dangerous relative to your net worth, trimming can be prudent. Not because silver is doomed, but because you're human. You have bills. You have responsibilities. A spreadsheet doesn't feel anxiety. A human does. So if a bank is talking to a retiree who can't afford a 40% drawdown, recommending more gold exposure could genuinely be clarity, not manipulation. Now the other version, the version that makes my antenna go up, is when client first advice mysteriously aligns with the bank's own stress points. Because silver is not just an investment. Silver is a stress test of the paper system. It's historically been used as everyday money across cultures, and that history matters for psychology. When people sense the unit of account is wobbling, they reach for what they recognize. Gold is the headline metal. Silver is that this is how normal people used to transact metal. And emotions create feedback loops. People see price, price creates headlines, headlines create buyers, buyers create more price. Then institutions step in with helpful narratives to slow the loop. That's why I don't ignore the messaging. Here's my skeptical counterpoint, stated plainly. If the bank is recommending clients sell silver, it may be because silver is the bigger threat to paper settlement mechanics, not because silver is the weaker asset. Now, I'm going to say something else that will bother some people. The banks are always short story is sometimes overstated. Big institutions hedge. They carry inventory. They run complex books. A large short position can be part of a neutral strategy. So I'm not saying evil bank, end of story. I'm saying incentives matter. And in a squeeze-prone market, incentives can produce advice that looks protective while serving multiple masters. So what do you do with that? You don't panic. You do due diligence on your own positioning. If you own silver for a long-term monetary hedge, then a bank call shouldn't change your thesis overnight. If you own silver as a short-term momentum trade, then a bank call might be a warning that the shakeouts are going to get nastier. Now let's pivot to the confiscation fear again, but with a twist that people rarely consider. Modern confiscation, if it ever happens, could target behavior, not ownership. Think about it. If a government wants to discourage a certain asset, it doesn't need to raid closets. It can adjust rules. It can change how gains are taxed. It can create reporting triggers. It can pressure institutions that provide storage and payment rails. It can make it hard to move metal across borders. It can even do something as simple as redefining what counts as cash-like for compliance purposes. The heavy hand can show up as paperwork. So the smarter question isn't, will they confiscate? The smarter question is, will they make it unattractive to transact? And if they do, you adapt. You plan storage, you plan documentation, you plan time horizon, and you avoid panic selling. Now let's bring in a piece of historical clarity that always shocks people the first time they really sit with it. In the early 1930s, the official price of gold in the United States was changed upward after the government gathered gold into official hands. That meant citizens who turned in metal got paid one price, and then watched the official number move to a higher price shortly after. The lesson is not just They can change rules. The lesson is policy risk is real, and it usually benefits the issuer, not the saver. Fast forward to now. The issuer of fiat units can expand supply. That expansion quietly transfers purchasing power away from savers and toward borrowers in the system itself. That's why I say confiscation already happens in slow motion. It's just called inflation and depreciation and policy flexibility. So if you're waiting for a dramatic event to validate your concerns, you might miss the quieter theft that happens every month. And this ties directly into why the Zurich technicians' forecasts, even if extreme, resonate with people. Not because everyone believes a specific target, but because people finally feel the underlying imbalance. Too much debt, too many promises, too little discipline. Now, let's talk about the parabolic math that makes people either laugh or lean in. When a market doubles, it feels big. When it doubles again, it feels unreal. But parabolic moves are not linear stories. They're stories of crowd psychology. Once a crowd believes a move is inevitable, the move can become self-fulfilling until something snaps. That's why the technician says faster moves tend to lead to faster corrections. It's not magic. It's how crowds behave. Here's what I want you to picture. Imagine a spring being compressed for years. The longer it's compressed, the more violent the release. Silver has spent long periods being ignored, undervalued, or treated like a sideshow. Meanwhile, its industrial importance has grown. And when a market like that starts to reprice, it doesn't politely ask permission. That said, I'm not here to sell you a fantasy. A summer spike could happen. It could also get delayed. The market can torture both bulls and bears. It can rally just enough to pull in late buyers, then dump hard enough to make them swear off the metal forever, and then rally again without them. That is the cruelty of volatile assets. Which brings us back to inflation-adjusted comparisons, because those are often used to anchor expectations. People take the nominal peak of silver decades ago and say, adjusted for real inflation, today's equivalent is astronomical. There are two issues with that. One, the inflation measure you choose changes the output dramatically. Two, the historical peak was a spike event, not a stable equilibrium. So I prefer a different lens. Compare silver to the size of the financial system that surrounds it. Compare it to debt levels, money creation, and the role silver plays in modern technology. In a world where currencies have been expanded aggressively, it's reasonable to think monetary metals have more runway. In a world where silver is also an input into rapidly growing industries, it's reasonable to think demand pressure can persist. And here's an uncomfortable truth. If silver truly starts behaving like money again in the minds of the public, the price discovery process could get disorderly. It could gap, it could limit up, it could get restricted. I'm not predicting that. I'm saying it's within the realm of outcomes when trust breaks. Now, let's tee up the final catalyst, the policy decision day and the press conference that follows. Markets have gotten very good at pricing the decision. They're less good at pricing the tone. A single phrase can move yields, move the dollar, and by extension, move metals. Watch the language about inflation. Watch the language about tightness and financial conditions. Watch whether they sound confident or cornered. That tells you more than the headline rate. And that's where we close the loop. Volatility is not random. It's the surface expression of stress. When the system feels stable, volatility sleeps. When the system feels fragile, volatility wakes up. And right now, volatility is wide awake. Now, let's talk about the Zurich Gnome, because this is where the conversation usually splits into two camps. The people who roll their eyes at big targets, and the people who get hypnotized by them. Neither camp is useful. The gnome is just my nickname for a technician I've spoken with off and on. Someone who lives and breathes chart structure and crowd behavior. He's not a magician. He's not a guarantee. He's a lens. And his lens is basically this. Commodities don't move like stocks. When they finally break, they move like they're trying to make up for lost time. So when he throws out a summer scenario where gold pushes to the mid four figures beyond, where people feel comfortable and silver goes into the kind of territory that makes headlines look fake, he's not saying this must happen. What he's saying, this can happen if the squeeze dynamics persist. And it's not a crazy concept. The reason the targets sound crazy is because your brain anchors to old prices. That's a human flaw, not a market law. Here's the problem though. The same mechanics that can launch price can also punish you brutally on the way up. Commodity advances often travel in waves. An impulse, then a savage correction, then another impulse. If you treat every correction like a betrayal, you will sell the exact spot the market is transferring inventory from emotional holders to disciplined holders. So the real question isn't, will we hit the target? The real question is, can you survive the path? Based on recently published numbers, the appetite for hedges has been rising across multiple categories, not just metals. When people feel uncertain, they don't all buy the same thing, but they do all try to reduce exposure to promises. And metals are the oldest anti-promise asset there is. Now, let me give you the grounded version of a big target conversation. Instead of staring at one price, you build scenarios. Scenario 1, the move cools off and consolidates. Price chops, frustrating everyone. That consolidation would feel like the market died, but it would actually be building a new floor. A boring market can be a powerful market. Boredom is how trends recruit patient capital. Scenario 2, the move continues and accelerates, but it does it in violent bursts. You get a week of euphoria, then a 2-day rug pull, then another burst. This is the most psychologically exhausting path because it keeps invalidating both bulls and bears. It's also the path that can carry farthest because it constantly resets sentiment without killing the trend. Scenario 3, we get a blow-off move, fast, vertical, and then a brutal crash. This is the path that creates legends and creates heartbreak. It's where people make money they've never made before and then lose it because they thought it was free. If this happens, the winners are usually the ones who had rules before the move started, not the ones who invented rules after they got greedy. I'm not telling you which scenario will happen. I'm telling you the market has multiple ways to hurt you. Your job is to stop being surprised by that. Now let's connect this to the inflation-adjusted silver arguments that are going viral again. Every time silver moves, people pull out a chart from decades ago and say, if you adjust that old peak for inflation, silver would be way higher today. The spirit of the argument is correct. Currency dilution matters. The execution often turns into clickbait because adjusted depends on what inflation measure you choose. There are independent analysts who rebuild older inflation methodologies, and those reconstructions often imply significantly higher cumulative inflation than the official prints suggest. If you plug that into a calculator, you get numbers that sound like science fiction. That doesn't automatically mean those numbers will print on a screen. It means the unit of measurement has been stretched more than most people appreciate. But here's the deeper point. Silver's old peak wasn't just about inflation. It was about panic. It was about geopolitics. It was about a unique attempt to control supply. It was about a monetary system in transition. When you stack rare circumstances, you get rare prices. So instead of obsessing over a single historical spike, look at the structural ingredients today. Ingredient 1, the monetary side. The modern system can expand credit and currency rapidly, and that expansion creates long-term pressure on purchasing power. Ingredient 2, the industrial side. Silver is embedded in modern technology. Even if you don't care about the industry story cares about you because it affects availability. Ingredient 3, the financial side. Silver is smaller and can be pushed around more easily than gold. That's a blessing and a curse. It can underperform for long stretches, then overperform violently. When you combine those ingredients, you don't need a cartoonish target to justify owning some exposure. You just need to acknowledge that the risk-reward is asymmetric for people who think the future will look like the past. Now, I also want to challenge one assumption that shows up in a lot of metal commentary, that every move is purely a currency story. It's not always. Sometimes metals rise because currencies weaken. Sometimes metals rise because real rates fall. Sometimes metals rise because supply chain constraints tighten. Sometimes metals rise because alternative assets become crowded and capital looks for something uncorrelated. In other words, multiple engines can drive the same car. If you pretend only one engine exists, you'll misread the turns. That's why I watch cross signals. How are mining equities behaving relative to the metal? How is the broader commodity complex behaving? How is the dollar behaving? How are bond markets reacting to policy language? Those relationships can change fast. And when they change, the next leg often starts before the public understands what shifted. From recent market updates, you can also see how quickly sentiment flips. Yesterday's unstoppable becomes today's top, and then tomorrow becomes unstoppable again. That flip-flop is not wisdom, it's noise. So let me bring this home with one more cliffhanger. The next big move is probably going to start when you feel the least confident. Because that's how shakeouts work. They make you doubt right before they reward. And that's why the upcoming policy messaging matters. If the central bank comes out and sounds relaxed, markets might interpret that as permission to take risk, which can push commodities higher. If they sound tense, markets might interpret that as tightening by another name, which can cause a short-term deflationary scare. Either way, metals can swing hard. The only certainty is the swing. So don't lock your identity to a single day's candle. Lock your identity to your process. And now, with all that said, we can talk about what to actually do with this information without turning it into a cult. Here's a simple trick I use on days like yesterday. I write down in one sentence why I own the position, not 10 sentences. 1. If I can't write a clean sentence, I'm not holding a thesis, I'm holding a vibe. Then I write one sentence about the risk. What would make me change my mind, not what would make me scared? That's the difference. Fear is emotional. A thesis change is informational. When you do this, volatility becomes data instead of drama. And when volatility becomes data, you stop donating your attention to headlines and you make decisions that make sense a month later. Now, none of this matters today if you don't translate it into behavior. If you're a long-term holder, volatility is a feature, not a bug, because it's the mechanism that transfers metal from impatient hands to patient hands. Patience doesn't mean passivity. It means you control your emotions. You don't let a one-day dump convince you the thesis died. And you don't let a one-day rip convince you the thesis is finished. If you're a trader, respect the fact that these markets can gap. They can overshoot a stop. They can move when you're asleep. That's not fear-mongering, that's reality. Here's the single most practical move you can make. Decide your rules in calm weather, not in a storm. If price spikes, what's your plan? If it drops hard, what's your plan? If you can't answer that, the market will answer it for you, and you won't like the answer. Also, remember those bonus links in the description. Premium WhatsApp channel link and the channel membership join link. If you want the deeper members-only research videos from the separate team, that's where you join. So tell me this. Do you think the next major move is going to be a sustained breakout or a fake out designed to crush late buyers? And what would convince you you're wrong? Subscribe if you want the next update the moment the market gives us another clue. Educational only. I'm sharing my interpretation and my process so you can make your own decisions with clearer eyes. I'm not your financial advisor, I don't know your situation, and I don't want you making money moves because a guy on the internet sounded confident today.